If I asked you right now, how much life insurance do you actually need? Most Americans would either guess or say, I'll figure it out later. But here's the truth that hits hard. The moment you finally try to figure it out is usually the moment your family already needed it. Life insurance isn't fun, it's not exciting, and nobody wakes up saying can't wait to talk about death today. But it is one of the few financial decisions that directly determines whether your family sinks or survives during the worst moment of their lives. And what shocks most people is this: you don't need to be rich to protect the people you love. You just need to know the right rule of thumb. Because yes, there is a simple rule most Americans can use to calculate how much coverage they need. And most people are way off. Some buy too little and leave their family financially exposed. Others buy way too much and overspend for decades. Today I'm breaking it down in the simplest, cleanest way possible. No insurance jargon, no confusing charts, just the real numbers, the real rule, and real examples that make it click. And after about a minute from now, I am going to reveal a second hook, the one thing almost nobody tells you about calculating life insurance. So keep watching. Imagine this: you're 32, married, one kid, another maybe on the way. You've got a mortgage, 2 car payments, groceries that somehow get more expensive every week, and a job that feels stable. Until it isn't. Now imagine something happens to you. Not next year, not when you're old. I mean tomorrow. What happens to your family financially? Who covers the mortgage? Who covers daycare? Who covers groceries, medical bills, the car, the future college savings that you swore you'd start next year? It sounds dark, I know, but this is exactly why life insurance exists. Not for you, for them. Most Americans don't know this, but the real purpose of life insurance isn't burial money. It's income replacement. It's about making sure your family doesn't lose the lifestyle you built just because they lost you. And here comes the second hook, the part almost everyone gets wrong. You don't buy life insurance based on what you earn today. You buy life insurance based on what your family would lose tomorrow. That's the mind shift that changes everything. Alright, let's break down the simple, proven rule of thumb financial educators use. The 10-15x income rule. That's it. 10 to 15 times your annual income. If you make $50,000 a year, you're looking at $500,000 to $750,000 of coverage. If you make $80,000 a year, your range is $800,000 to about $1.2 million. Most Americans are shocked by how big those numbers sound, until they realize what that money is meant to do: replace years of income your family will no longer have. Because here's what people usually mess up. They think life insurance should cover burial costs, maybe a few months of bills, then everything magically works out. That's not how the real world works. Bills don't disappear. Mortgages don't forgive themselves. Groceries don't suddenly get cheaper out of sympathy. Let me give you a real world example. Meet Ryan and Emily, a young couple living in Ohio. Ryan makes $65,000 a year working at an auto shop. Emily works part-time because they have a 3-year-old. They have a $240,000 mortgage, 2 used cars, and student loans Ryan is still chipping away at. One night they're reviewing their budget and Ryan says, "Do we actually need life insurance? I'm young, I'm healthy." Emily doesn't push it, but she says, "Just get a quote. It's probably cheap." Ryan checks and realizes he can get $750,000 of term coverage for the cost of like 2 pizzas a month. And think about that, for the price of dinner? His family becomes financially safe. Now imagine Ryan didn't get it, and something happened. Emily loses his income. She still has daycare bills, medical bills, the mortgage, and no replacement income. That family goes from tight but stable to "we might lose everything overnight, but with $750,000? Emily could pay off the house. She could cover years of bills. She would have time to breathe, time to grieve, and time to rebuild. That's the point. Now let's go deeper, because you know I never give you the surface level answer. The 10-15x rule works for the average American, but there are reasons you might need more or less. Here's where people usually mess up. First, debt. If you've got major debts, especially a mortgage, you need coverage that clears that weight for your family. If you die with a $300,000 mortgage, your partner inherits the payments. Many people forget that part. Second, kids. Children multiply the need for insurance. Why? because they rely on you financially for a long time. Think about daycare, clothes, food, sports, medical bills, and maybe the dream of helping them through college. Third, your income. If you're the main income earner, the primary breadwinner, the amount needed skyrockets. If you bring in 70% of the household earnings, your coverage needs to reflect that. Fourth, your future goals for your family. Do you want them to stay in the same home? Keep the same education path? Not drown in bills or sell everything just to survive? Your life insurance amount should match the life you want them to keep. Most Americans don't think like this until someone sits them down and explains the math. And the math isn't complicated, it's emotional. It's about stability, safety, protecting people who depend on you. Let me give you another real American example. Maria is a single mom in Texas. She works full-time as a dental assistant, making $58,000 a year. Her son, Mateo, is 7. She doesn't have a spouse to fall back on. She is the safety net, B-roll. Single mom dropping child at school. Maria used to think life insurance was only for married couples, until a friend told her, if something happened to you, who takes care of him? Who pays for his food, school, clothes, everything? That hit her hard. She used the 10-15x rule. 58,010 equals $580,000, 58,015 equals $870,000. She ended up choosing $750,000 of term coverage for about $30 a month. That's a few coffees. That's less than a phone bill. But to Mateo? That's the difference between growing up safe or growing up struggling. This is why life insurance matters. It's not dramatic, it's protective. Now let's talk about one of the most misunderstood parts of the calculation. Your job and future earnings. Wait, this next part surprises almost everyone. When you buy life insurance, you're not just protecting today's version of your income. Say you're 27 making $45,000. You're protecting future raises, future promotions, career growth, the potential your family would have benefited from. That's why the 10-15x range exists. 10x is for people with stable incomes, few debts, or no kids. 15x is for parents, homeowners, and anyone who expects to earn more over time. So if you're young, choosing the higher end of the rule actually makes more sense. It locks in low rates early and protects your rising income later. Most Americans don't know this. But your life insurance rate is based on your age and health right now, not the coverage amount. Meaning doubling your coverage often only costs a few extra dollars. That's why buying early is such an underrated financial move. Let's break down one more real story, something that happens way too often. A man named John, 41, living in Florida, has 2 kids, a home, and a good job as a project manager. He earns around $90,000 a year. He's healthy, works out, no major medical issues. He decides, I should probably get life insurance. He does a quick online calculator and chooses $250,000 because that sounds like enough. Here's the problem, it wasn't. If John passed away, $250,000 wouldn't even cover 3 years of lost income. Not the mortgage, not the kids' expenses, not their future education. His family would burn through that payout faster than he ever imagined. This is the mistake people make. They decide based on what feels enough, not what actually replaces their income. That's why the rule of thumb exists, because your feelings don't pay bills, numbers do. Now let's talk about something else most people forget. Your spouse or partner. Even if you're the primary earner, your partner needs coverage too, and here's why. If your partner passes away, even if they don't earn an income, their value has a financial impact. Childcare, transportation, household tasks, the emotional bandwidth they provide. If they're gone, you'll be paying for help or reducing work hours to fill that gap. A stay-at-home parent needs coverage, often $250,000 to $500,000 just to support the surviving parent through the transition. Most Americans never think about this until they see the real numbers. Next, let's talk about term length. Your coverage amount is your what? Your term length is your how long. Most families choose 20 or 30 years because those terms cover the years when kids are growing, mortgages are highest, and income is most needed. Choosing a slightly longer term can protect your family until kids are financially independent and debts are mostly paid off. It's not about guessing perfectly, it's about covering the years when your loss would hurt them the most. Now let's touch on something people overcomplicate. Your employer's life insurance. Most jobs offer 1 to X your salary for free. That's great. But it is not enough. If you make $60,000 and your employer gives you a $60,000 policy, that's barely 1 year of income. It's a cushion, not protection. That's why you should never rely solely on job-based coverage. Keep it, sure, but pair it with a personal term policy you control, one that stays with you even if you leave the company. Let's bring everything together with a simple checklist, not advice, just education. Most Americans can estimate their life insurance needs by asking, do I have people financially dependent on me? Do I have major debts like a mortgage? Do I want my kids or partner to stay financially stable without my income? If I disappeared tomorrow, what yearly income would my family lose? How many years would they need financial support? If the answer to any of those is yes, the 10-15x rule is a powerful starting point. And if you're still unsure, here's the simplest way to think about it. Choose the amount that lets your family grieve without immediately worrying about money. That's the heart of it. So before we wrap up, let me leave you with this. Life insurance doesn't protect you. It protects the people who love you, depend on you, and trust you to take care of them even when you're not here anymore. Most Americans procrastinate life insurance until it's too late. But the families who are protected are the families whose loved ones made the decision early, quickly, and confidently, even if they didn't feel ready. And the best part? This isn't a complicated financial move. It doesn't require investing knowledge. It doesn't require money you don't have. It's simple, affordable, and one of the most loving decisions you can make. If you want a deeper breakdown, term versus whole, how to choose the right term length, or how to get quotes, comment more and I'll make a part 2.